I was going through your notes, and you outline an investor survival guide to navigating this coronavirus-driven bear market. Outline that for us.
So basically, the most important thing is sort of to take a longer view. If you're looking at the stock market on a 9 or 12-month basis, you're then looking at 2021 earnings, and we think on that basis stocks are pretty cheap. You can buy here. You definitely can hold through the ups and the downs. So that's number one. Two, don't get caught up in the day-to-day volatility or market swings. This market is basically impossible to time. So if you think you can get in or out based on the news, it really is going to work against you. Stick to your long-term asset allocation. If you did have cash on the sidelines you were thinking to put into stocks, if you have a longer-term view, you can buy, but we wouldn't buy on days like today. We'd be buying on days where the market's down 300-500 points. So those are some of the starting part of how to really navigate this market.
So if you have a longer-term time horizon in place, then how does the recovery trajectory factor in? What are you forecasting? Are you forecasting a V-shaped recovery or something that's more L-shaped? I mean, we heard from Bill Gates earlier today, the latest this week, who is suggesting that the economy won't return to the way it was anytime soon, that this could be a much more gradual process. Does it matter if you're a longer-term investor?
Well, it matters on a short-term basis, on a longer-term basis. As long as the economy doesn't fall out of bed and it can recover, we think people are going to look, or the market's going to look toward next year's earnings. And on that basis, we think you will have a pretty significant recovery. And with interest rates at zero, with the Fed doing everything to defend the financial markets, with the federal government spending trillions of dollars, there's going to be a lot of money out there. We think demand and the economy probably comes back quicker than people expect, as long as you get some sort of normalization on the healthcare side. If there's any sort of progress on treating the coronavirus, we think you would have a much quicker than expected recovery. If it's quicker in terms of coming up with a vaccine, we think you're going to have a pretty robust recovery. And it's very important when you look at the stock market looks at out earnings. So we are going to have a dismal earnings season right now. The first quarter, the second quarter earnings are going to stink. Companies are going to pull back on guidance. But as long as a company has a balance sheet that they can get through this and they have a good long-term franchise, the market is going to look out at earnings. And based on that, stocks are pretty inexpensive.
David, given your expectations around the tone of earnings, how much cash should investors keep kind of as dry powder prepared to buy during those periods versus deploying it now? I mean, I gather that you're saying don't dump all your cash into the market at any given time because you can't time it. You've got to be strategic about it. But how key will those earnings reports be in helping investors figure out when to move?
We don't think they're going to tell a lot. What you're going to hear from companies are that business was good in January and February, fell off a cliff in March. They're pulling guidance. Hopefully you'll hear companies talk about having the cash flow to get through this, what they've done in terms of their credit lines or refinancing or solidifying their balance sheet. For many, many companies, they're going to affirm their dividends. All of those are good signs. Even though business is going to be falling off a cliff, they're going to basically take away or suspend any sort of earnings guidance. So those are the negatives. The key is going to be, are they going to be a survivor? And based upon normalized earnings, how is their valuation? And we think that the market is going to give a lot of companies a pass in terms of poor earnings. The ones that aren't going to get a pass are either hotels or airlines or automobile companies that are really having a cash crunch and can run out of money. Those companies are going to be more worrisome. So we think you can invest in the market. We think there are lots of places that you can put money, and we don't think you need to buy some of those riskiest areas. There are many stocks that are down 30, 40, 50% that really don't have significant risk.
Hey, David, it's Carl. A lot of our viewers obviously interested in what percentage of their portfolio should be gold. Powell this morning said inflation's not a first-order concern. I mean, is gold overstating the threat of inflation in the near term?
We think that next year you could start to have some inflation, but if interest rates start to go up, all of a sudden it costs more money to borrow for gold. So we don't think that gold should have a significant place in the portfolio. We're not great believers in it. If you can catch the trade right, you do really well. If you catch it wrong, you can have 3-5 years where you don't make anything out of gold. The flip side is some of the stocks that we're recommending are paying about a 3 or 4 or 5% dividend. So while you're waiting for things to get a little bit better, and they will get better one day, you're getting 4%. Contrast that to getting 0.74 in a 10-year Treasury or getting 0.2 in a money market account. When you buy gold, you're really not getting any sort of income along the way. You can buy real conservative stocks, get income, and we think that over time, and over time is 9, 12 months, they're going to have a lot more appreciation potential than gold.